Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA Podcast Series, and today's guest is Robert Miner. According to Miner, if you are not willing to do the necessary work for the information needed to make a trade decision, you have no business with a trading account. Robert Miner has been a leading trading educator for more than 20 years and publishes daily reports on Forex, stock, and futures markets. He speaks around the world on trading and has written for a wide variety of trading publications. Miner has been named Guru of the Year and is first place winner of a major brokerage company's annual real-time trading contest. Miner is also the author of High Probability Trading Strategies. Welcome to the program, Bob.
Thanks for having me. Great to be here.
Where is here? Where are you calling from today?
Well, I'm calling in from Medellin, Colombia, where I've been for the past couple weeks. My son has lived here for about 5 or 6 years, so I come down 2 or 3 times a year to visit. And my son is also the chief technical writer for our daily reports, so of course it's a business trip.
Well, that sounds fantastic. Thanks for breaking away to spend some time with us today.
Yeah. It's a fantastic country. Hope more people can visit it.
Well, let's start with your background. How did you come to learn the financial markets?
Oh, I think it's kind of early to mid-'80s. I read a book on commodity trading I got from the library. Frankly, don't remember who was the author, but it just got me very interested. For some reason, chart patterns and the numbers and all of that sort of thing. So I just began a self-education project for those several years. And then actually eventually in the latter part of the 80s began writing a market report on gold, silver, and platinum trading.
How would you describe your style of trading? What are your go-to angles on the market?
Well, I'm not sure style of trading. I don't really know what style of trading is, what that means. But I have 4 major factors that I look at when gathering information to make a trade decision. And that is multiple time frame, momentum, and then time, price, and pattern. And so we can talk about one or all of those or any one of those today, but that's the information that I use to understand the market position, what's likely to happen, and whether a market's in a position to make a trade or not.
Well, let's talk about some of those. Do they all have equal weight? Is there a tiered approach? When you approach a market, what do you do first?
Yeah, the first is something that's actually the most recent I've integrated. When I say most recent, in the last 5 or 6 years, since I'm pretty close to 30 years of trading. The most recent is multiple time frame and multiple look-back period momentum setups. That becomes my first filter to decide if it's even a market or a setup or a trade that I want to consider. And what I mean by multiple time frame momentum setup would be, let's just say we're looking at weekly and daily data because we're kind of intermediate position traders. We look at the momentum trend in the weekly, and that would set the direction of the trade. And then it would be momentum reversals in the smaller time frame daily. That would be the setup to consider the specific trade entry strategy. So we want the momentum of at least 2 time frames and preferably 3 time frames to be in the same direction. And this doesn't matter what market or what time frame. We could be looking at 60-minute, 15-minute, and 5-minute data. So the market and the time frame is kind of irrelevant. We just want to have at least 2 or 3 momentum time frames of momentum in the same direction.
Okay. So once you identify a market that's moving in your direction, what are your next steps?
The price and time position and the pattern position. Pattern position that I use is based on Elliott Wave. I've written a lot about Elliott Wave in the last 20 plus years with a focus on simplifying and looking at just a couple basic rules and guidelines and 2 or 3 of the basic patterns that are easily recognizable. So what Elliott Wave does is help you understand the position of a market within a trend. Is it in a trend or a counter trend, and is it at or near the end of that trend or counter trend? And Elliott wave is certainly not foolproof, and that there's not just a very limited set of patterns that always resolve themselves the same way, but there are some general guidelines, some general structures to the patterns that can be really, really helpful. So that would be my next thing that I'd look at. And by the way, most people think Elliott wave is very subjective. It's not. It's very objective. Everyone has been properly taught the basics and simplified structures of Elliott wave. If they look at a market, they should all come up with the same resolution, same idea. So after that, a real key is, what are the key price reversal points? And I have sort of multiple time frame price strategies that help to focus in ideally on a fairly narrow price range, which should be the termination, and I should say which is typically the termination of a trend or a counter trend. So if we have a multiple time frame momentum that indicates the trend should be in a particular direction, if we have a pattern structure that indicates maybe, let's say for instance, that the correction is about over, so the major trend is going to continue, and if we have a market that's right in a price reversal zone, all three of those are telling us basically the same thing, and that's a setup that we'd consider for a specific trade strategy.
Okay. So you just touched on a little bit, but your book is titled High Probability Trading Strategies. In your book, you say that no technical analysis technique, pattern style, or pattern signal trading strategy works every time. So what is a reasonable expectation for high probability? Are we talking 50%, 60%? What do you mean by that?
Well, in the language of trading, high probability may have a little different reference than in some other scientific endeavors, let's say. High probability, and I'm assuming you're referring to high probability of success, that the trade will be closed out with some profit.
So well, that's always the hope, I guess.
Yes, exactly. That's what we're meaning by high probability. High probability in trading is if around 50% of your trades are profitable, you're up there with the elite traders. And 50% doesn't sound like high probability, but again, in the world of trading, it is. And of course, whether you can make a business of this, of trading, has to do with what's your average or typical profit and what's your average or typical loss. And of course, losses in a good trading plan and with any successful trader are going to be relatively small, so you can have quite a few losses, and your successful trades, profitable trades, should be relatively large, so that your profits in the long run, your net profits are much greater than, or your net profits are substantially positive, even though you may only have about 50% of the trades that are actually profitable.
Mm-hmm. Let's talk about time bands. I personally thought this was a great nugget in your book. You have simple techniques for projecting potential turning points in the market. Can you describe time bands for us?
Yeah, I think so. And again, this is in timing is something that most traders don't integrate into their trading plan. So time bands are really quite simple, and they're really a continuation of what Walt Bresser taught over, probably 30 years ago or more in his timing bands. I just do it a little bit different. So what's a time band? A time band looks at the past rotations in the market, and it measures, let's say we're looking for a high in the market. We're looking to project the high probability time for a high. We would look at relatively recent data, the last 10 to 15 repetitions or cycles, and measure the high to a high, throw out the two outliers, which would be the extreme, if there's an extreme one that's long or extreme one that's short, and we get a little range. Let's say the range is from 12 to 15, every 12 to 15 trading bars, there tends to be a high that's made. So we have a little bit of a range that we want to be aware of for a high. Now we want to maybe narrow that range down. So then we measure what's been the typical range of bars from low to high over these last 10 to 15 cycles. And maybe that's 8 to 10, every 8 to 10 bars from the low to the high. So we take the range from the high to the high and the range from the low to the high, project those forward, and we look to see where do they overlap. And where they overlap, based on recent cycles, is a very high probability that we're going to have the next similar time frame high. So it's simple, it's logical, and it's extremely helpful.
Now, does this work to project lows as well?
Of course, yeah. It's the exact same approach if you're looking to project a low. And how it's different than typical, let's say, cycle analysis, which is looking at some consistent fixed cycle length, is that we're looking at relatively recent data and we're looking for a relatively narrow range of this cycle. These cycles will change over time as far as the ranges. So we really want to focus in what's the immediate sort of cycle that is influencing the market that we can take advantage of.
Sure. And if you're looking for lows, would you flip what you were looking for? Instead of looking for the high to high, you'd be looking for the low to low. Is that
Absolutely
correct? Okay.
You look for the kind of typical range of low to lows over the past anywhere from 10 to 15 cycles, and then the typical range or the range of the high to lows. And we look for where those two ranges overlap. This is something I used to do just in spreadsheets 20 some years ago. Of course, I built it in to more automate it in my software, but it's just really effective and it's really helpful.
I liked it too.
Yeah.
I thought that was a great nugget.
Think of this and how logical this is. Let's just say that you have a 4-bar range that is likely to make, I'll call it a daily low, which is a low that's going to last for a week or two. And you have that 4-bar range. And you wait until a market, let's say it's coming into a low, and it's coming into that range. And then we have a dual time frame momentum that's indicating we're at or near that momentum low. And the price is coming down into some corrective support zone. So this is how we put all this information together is the momentum on our side from more than one time frame, is the timing on our side from preferably more than one time frame, is the price on our side from multiple time frames. And if all those things come together, we've got a really high probability that the market's going to reverse. And the beauty of it is that with the trade strategy that at least that I teach, is that you have a completely objective, at that point, objective entry and stop. So you know exactly what it's going to cost you to find out if the market's going to be cooperative.
Mm-hmm. Well, you've been in the markets for decades, Bob. Is there a trade that stands out to you as being very memorable?
The last profitable one.
What was that? What was your last profitable trade?
No, I'll give you a better story than that because it's not particularly exciting. But there's a big lesson to be learned from this. And this is several years ago before we even had online accounts or online trading. We actually hand charted and have to, call our trades into a broker who charged, $80 round turn or something like that. But and there's a current lesson to be learned from this is that I was out of town. I was actually speaking at some conference and up a little late that night and a little groggy the next morning, and I had a trade on. I said, I need to just close this out because I know the next 3 days is just going to be, sightseeing and talking with people and not paying attention to the market. So I actually, picked up the phone. I don't remember whether it's long or short, but I do remember it was a gold trade, and whatever the position was, I said sell that many units. So I hung up, thought, okay, I'm flat. Now I can go out and have some fun. And, I'm not going to be home for a couple of days. So I get home and I find that it was like dyslexia of orders is that instead of sell, I said buy, and I doubled up on my position. So of course, nobody but me has ever done that. But this is my memorable trade is the market actually went in my direction. So it actually ended up being very profitable. It could have gone, just the opposite way, and I would have had an open position, and it could have been a big loss. So the lesson to be learned is know your positions at all times. Know your stop loss at all times. I know this sounds silly, and anybody who's been trading for a while knows how important this is. But in all the years I've been helping people also learn to trade, you would be surprised at how many people have an open position, don't have an open stop loss, and don't have a little. I still write down my trades and have them on a little pad in front of me, so I'm reminded exactly the position of where the stops are. So know where you're at, have good bookkeeping, good record keeping, so you don't make a big mistake like I could have made.
Where do you think we are at in the markets today? We are recording this in mid-September here. The markets are moving sharply higher in the last week or so. What do you see happening?
I think actually it's kind of timely we're talking now that the stock indexes anyway are making a corrective rally. They have been up for a couple of weeks now, but I think that's a correction. I think we're about to complete the high of the year if it hasn't been completed in the S&P at least here within the next week. Technically, all the technicals say, from my point of view, is that we're making a corrective rally. We should complete a high, at least a weekly high, within the next week, and then the market should be down for several weeks. There's some longer-term sort of cycles that would indicate that it's more important than just a weekly high. So I think if anybody listens to this in the next, even within just the next few weeks, they'll see how that all worked out.
Excellent. Well, we are running out of time. That went quickly. Is there anything you would like to add before we go?
No, except, yes, yeah. For anybody listening, go ahead.
How could somebody get in touch with you if they wanted to read your newsletter?
Mm-hmm.
Yeah, go ahead.
DynamicTraders.com. DynamicTraders.com. And we've got all the information there about our products and services, our educational material, our newsletters, and our software.
Fantastic. Thank you for your time today, Bob.
You betcha. Glad to be here. Thanks for calling, and take care until next time.
Today's guest has been Robert Miner, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.